Wealth is a registered investment advisory firm. We are true fiduciaries for our clients. Our clients' assets are custodied with Charles Schwab. Bogart Wealth's core competencies are financial planning, tax optimization, and investment management. There are actually now 15 of us on our team here. And I wanted to welcome our newest addition to the team, Nell Cordick. She joined us on Monday. So welcome. She had over 15 years with BB&T. Extremely excited to have her on board. Bogart Wealth has 3 offices, one up in McLean, Virginia, one in Houston, Texas, and then one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. Your kids, your parents are some of the largest variables in anyone's financial plan. We've made it part of our firm's culture to give them access to certified financial planners. And one of the calls to action or for Bogart Wealth is to focus on educating our customer base and prospective customer base. We do an extensive series of educational events. One's the retirement planning timeline, one's on retirement income planning, one's on Social Security strategies, one on tax planning and tax optimization strategies, estate planning strategies, net unrealized depreciation and post-retirement strategies, as well as long-term care insurance, and then Roths versus traditional 401ks and IRAs. Traditionally, historically, we've been doing those events live, both in Virginia and in Texas. I will admit that, given the pandemic, we're probably going to be doing a lot more web-based, but we're going to look at a lot of different scenarios today. My goal really is to educate on the differences between Roths and traditional IRAs and why it should make sense to look at doing some conversions. But if there's a topic that you'd like to hear us talk on, we're going to be doing webinars for the foreseeable future. I've been doing them every week. I'm trying to get them down to about 30 minutes a piece, just for everyone's time benefit. But happy to add additional talks on here as well. All right, so today we're going to talk about saving and tax optimized accounts, the difference between IRAs and Roth IRAs. Then we're going to talk about backdoor Roth IRA contributions, as well as some Roth conversion strategies, both for retirees as well as those who are actively employed and looking at specifically saving within the ExxonMobil savings plan. So first up, let's talk about qualified accounts. This is going to be referring to traditional 401k accounts, traditional IRA accounts, 403b accounts, 457 accounts. But we talk about the good part first. And the good part is that with qualified accounts, you put money in on a before tax basis. So you're reducing your taxable income at the highest marginal brackets. You do not pay any tax on gains, the appreciation, until it's withdrawn. You don't pay any tax on dividends. And then also, for most of you who are participating in an employer plan, you'll receive a company match. Now, qualified plans do have some negatives to them. First is there's a 10% penalty if you take money out early, prior to the age of 59 and a half. Every dollar, both cost and appreciation, is taxed at ordinary income when you take money out. And then when you reach that magical age of 72, you're now eligible for what is called required minimum distributions. Required minimum distributions, or you might hear me call them RMDs, is when the IRS forces you to start taking money out of any of your retirement accounts. Now, I will admit there were some rule changes, part of the CARES Act I talked about last week, that are applying for 2020 only, which is they waived the early withdrawal from qualified accounts. So there is no 10% penalty for the year 2020. They also waived required minimum distributions for the year 2020. So that's actually creating a lot of strategy work that I think may make sense, especially for those who are already over 72 and need to do RMDs. All right, so getting a little deeper here. When it comes to contribution limits to qualified accounts as well as Roth accounts, Roth 401k accounts, you can actually put $19,500 in if you're under the age of 50. You can also put an additional $6,500 in if you're over the age of 50. That's the catch-up contribution. And then there is a max that you can actually put all into retirement accounts, which is $57,000 if you're under the age of 50. It's $63,500 if you're over the age of 50. So some people say, well, if I can only do the 26,000 combined here, how do I get to 63.5? Well, think of it this way. If you're over 50 and you can put 26,000 into a 401k plan, let's just say that the company match portion is an additional 14,000. So that puts you to a combined total of 40,000. You actually can put an additional amount in on an after-tax basis of 23,500 in order to fully maximize the contributions into the retirement plans. Somebody just asked, did I say that there's no penalty to withdraw right now, even if under 59.5? That is correct. So for 2020 in the CARES Act, that rule just went into effect last week, excuse me, last Friday before last, that there's no penalty to take out of a retirement account. Another question that came in is, are catch-up contributions pre-tax? I assume they are. The answer is yes. So if you're over 50 and you can do this 6,500, it's an additional pre-tax amount that you can put in. So if you're over 50, you can put 26,000 in before taxes. So it's reducing taxable income at the highest brackets, which we'll talk about what implications are there in a minute. Okay, now for IRA accounts, there's actually the ability to do deductible IRA contributions as well as non-deductible IRA contributions. I'm going to talk about the bottom section here first, which is deductible IRA contributions. So if you're under the age of 50, you can do $6,000 into these. If you're over the age of 50, you can do an additional $1,000 catch-up, so a total of $7,000. Now, in order to be able to do a deduction, there are income thresholds that come into the equation. So if you're covered by a plan, meaning you have a employer 401k plan available to you, if you make over 124,000 married or 75,000 single, you're not able to take a deduction on an IRA contribution. This is a traditional IRA contribution. Now, if one spouse is covered by a plan, but let's just say there's a spouse that's not working, that means that they would not be covered by a plan. The income threshold increases up to $206,000. It starts phasing out at 196. Now, that said, you can actually still do contributions into an IRA account. Again, $6,000 if you're under 50, $1,000 if you're over 50, and there's no income limit if you plan on not taking a deduction. I'll talk about why that might make sense more in a few minutes. But the point is as long as you have earned income, that's the most critical part. If you have earned income or your kids have earned income, you can put money into retirement plans. The question really becomes, can you take a deduction, or is there ability does it make more sense to potentially look at Roths? I got another question coming in. You've indicated that dividends are not taxed. Does that apply to direct distribution of dividends versus reinvesting them? So I'll jump back to that slide. So I'm specifically talking about within 401k plans. So let's just say, for example, you've got ExxonMobil stock in the 401k plan. And if the dividend as it pays just goes and buys new shares of ExxonMobil, there's no tax implications there. Now, ExxonMobil's 401k, and I'm using this as an example, but ExxonMobil's 401k has the ability to distribute your dividends to you. And if you do that, then that becomes taxable income as you do that. All right. Now, let's talk a little bit about Roth 401ks as well as Roth IRAs. So with Roth IRAs, you put money in on an after-tax basis. Now, you're putting in your contributions, again, after taxes. Now, if you're doing it within a Roth 401k, the amount that the company's matching is actually going into the pre-tax amount, which is the traditional 401k account. Most people actually get confused with that. Now, with Roths, you get tax-free growth, you get tax-free withdrawals of your principal, and then you get tax-free withdrawals of your growth, assuming that you're over the age of 59.5 and the accounts existed for 5 years. Now, there is a 10% penalty of appreciation or gains if you take the money out early under the age of 59.5. Now, one of the most beneficial parts about Roth, in addition to the tax-free growth, is that Roth IRAs are not subject to those required minimum distributions. However, Roth 401ks are. So if you've got money sitting in a savings plan and you've been putting money over into a Roth 401k, you absolutely want to make sure that by the time you reach the age of 72, that you've gone ahead and rolled out your pre-tax amount to a traditional IRA, and that you've rolled out your Roth 401k amount to a Roth IRA. For exactly this reason, Roth IRAs are not subject to RMDs, meaning you're not forced to start taking them out, but the Roth 401ks are. Now, one other thing that's really, really nice about Roths is that your beneficiaries will also inherit them tax-free. So when we talk about qualified accounts versus Roth accounts, with qualified accounts, when the beneficiaries receive them, they actually have to now take them out over a 10-year period of time and pay ordinary income on traditional 401ks as well as traditional IRAs, 403bs, and 457s. Now, with regards to Roths, that 10-year rule still applies. They still have to take them out over 10 years, but it's going to be tax-free to them. So the difference is ordinary income when they inherit it versus tax-free when they inherit it. Another question that just came in, what's the difference between non-deductible contributions to a 401k versus contributions to a Roth 401k? All right, so non-deductible contributions. So non-deductible contributions would be after-tax contributions. So let me jump back to this slide right here. Now, when it comes to the ability to what you can put into a 401k, it's 19.5 if you're under the age of 50, 6,500 of catch-up, so 26,000 total if you're over 50. Now, you have the ability to do 26,000 into a 401k plan either on a before-tax basis or the Roth 401k. So it's 26,000 total. Now, it's not combined. So if you put any amount into the Roth 401k, that's actually going to reduce the amount of pre-tax that you can put in. That's also reducing your taxable income. So just something to be aware of, because I have seen people where they're putting 2% into the Roth 401k, and it is reducing what's reducing their taxable income. Now, with regards to the question that I just got on non-deductible contributions, if you remember that example that I gave you of 26,000 of contributions that you put into the 401k, let's say they're all pre-taxed, and then let's just say that your company matches 14,000, so you've got now a total of 40,000 that's gone into the plan. You have the ability to do after-tax contributions, which is what are non-deductible contributions, and those will go in to the 401k on an after-tax basis. It's very different than a Roth 401k because when that after-tax goes in, all of the growth on after-tax, if you leave it in the savings plan, is actually growing tax deferred. So it's in the pre-tax amount. Now, the amount that you've put in after taxes, you're going to be able to take out tax-free or roll to a Roth IRA. I'll talk about that more in a minute. But there's benefit in having both within the plan. And so something as you're talking about where your savings, and that's one of the ways that we're helping the most, but I absolutely want to leverage, especially if you're in the later stages of your career, this 26,000 before tax, because if you're in the later stages of your career, you're probably in the highest tax bracket you're ever going to be in. It's most likely higher than what you're going to be in once you've retired, and we can now manage where taxable income is coming from. But then after that, I'd like to see, obviously you're going to get the 401k match, but I'd also like to see you go back, and if you have the ability to save more, do it on an after-tax basis within the 401k plans. All right. Now, with Roths, Roth IRAs, you'll notice the contribution limits are the same. So you can do 6,000 if you're under the age of 50 with an additional $1,000 of catch-up. Now, with Roths, there's only two ways to get money into Roth IRAs. First is contributions. The second is through conversions. Now, if you do a contribution, there's some income phase outs again. So if you're married, it starts phasing out at 196,000. Up to 206, you're no longer eligible to do a Roth contribution. If you're single, it's 124 up to 139. Now, we talked about contributions, so you can do up to 7,000 of contributions. You also have the ability to do what are called Roth conversions. Now, a Roth conversion is actually a penalty-free taxable transfer of amounts from a traditional IRA or traditional 401k over to a Roth IRA or Roth 401k. You can convert part or all of the money from a regular IRA to a Roth. You can also convert your traditional IRAs to Roth IRAs. You'll definitely have to be paying income taxes on those conversions. Now, prior to 2010, there was an income threshold on where you were even eligible to do conversions. That was $100,000. After 2010, they completely eliminated the income threshold to do conversions. So now this is a strategy for the last 10 years that we can do no matter what your income is. I have another question. I have 1099 income and salary income. Can I contribute to a Roth IRA? I'm 59 and a half. The answer is yes. So you can actually contribute to retirement accounts no matter what your age is. The critical part is you have to have employment income. Now, if you have 1099 income, we might want to consider a SEP IRA, which is another type of retirement savings account. We can talk about that more one-on-one as well. All right, now this is a nice slide that kind of summarizes the benefits of Roth IRAs. I'm not going to necessarily read every word, but it emphasizes the points that we've been trying to make here, which is you can do contributions at any age. The qualified distributions are income tax-free, and again, that's if you're over the age of 59 and a half, and if it's been in existence for 5 years, you can get all of the growth out tax-free, and there are no required minimum distributions during the Roth owner's life, which is awesome. They're great ways to look at it from a tax diversification perspective. Now, ultimately, the question is where is your income now versus where is your income in the future? Because, and I'll use some examples here in a second, but then also, are you planning on transitioning wealth to your heirs? And ultimately, if it's your kids, if we can find a strategy that reduces your taxable income now, long-term, but also transitions wealth to them tax-free, I would say that that's a win-win with regards to strategies. So factors that favor a Roth IRA. So if your income tax rates are going to be high in the future, you should be looking at doing Roth IRAs now. A lot of your children, for example, if they're early on in their careers and their income's low relative to where it's going to be, let's see them do Roth now and then look at pivoting over to a traditional function as their income rises. Now, if you expect your income and spending to go significantly faster than inflation between now and the end of your plan, we should also look at doing a Roth IRA. If income tax rates all go up in the future, so by the way, we do know that in 2026, with no legislative reform, tax rates are going to go back to what they were prior to the 2018 tax reform. Another reason to look at doing Roth IRA strategies is if you're in what we've grown to affectionately call RMD prison. And I'll show some examples of this, but this is where if as we're looking at the future assumptive growth of your portfolio and what those required minimum of distribution amounts are on your IRA and 401k accounts, if those are going to force your taxable income higher in later years, then maybe we should look at doing some Roth conversions when we're in some lower tax bracket years. And I'll show some examples of that in a minute. And then also, if you anticipate leaving a large legacy to family or individuals, Roths are always better because it's tax-free to them. Now, we do know that our tax structure is progressive in nature. And what that means is that we go from the 10% bracket to the 12, to the 22, to the 24, to the 32, to the 35, to the 37. Because of the progressive nature of our tax brackets, that is 1000% favoring saving the 401k when you're in these high bracket years. Because again, the contributions are being made at the highest marginal bracket. So if you're fortunate enough to make $300,000 and you're, well, let's use a little higher number. Let's just say you're filing jointly. Let's say you make $326,000. Over that, well, you know you're in the 32% tax bracket. So if you make $350,000 and you put $24,000 into the 401k plan, you've actually brought your taxable income back down to the 24% bracket. And the same rules apply all the way through here too. But the one thing that most people tend to forget is that when they take money out of a retirement account, their effective tax rate is no longer based upon the marginal progressive nature of our tax structure. So said another way, if you take $100,000 out of your 401k plan, you're actually not paying at that particular point in time a flat 22% on that entire amount. Well, forgive me, if you're single, that's going to, if you're jointly married, that's going to be 22 to 12. But ultimately, because the brackets increase in nature, they go from 10 to 12 to 22, you're paying a lesser amount because the first $19,750 were at 10%. The remaining portion up to $80,250 is at 12. And then the delta, the roughly $19,750 that I just mentioned in that example, would be at 22%. So your effective tax rate is lower. And I'm going to use an example to just show this real quick. So assume you're married and each of you has earned income of $80,000. So a total of $160,000 of combined income. We'll know that your marginal tax rate is 22%. Let's say you've got $20,000 to fund in your 401k combined this year. So with traditional 401ks, if you put 20,000 in, your taxable income, again, because we're reducing at the highest marginal, is now $140,000. If you were to have saved the same amount into a Roth IRA, you're only going to be able to save $15,600 because you're going to have to pay the $4,400 of taxes to get it in there. So again, while you're in high brackets, you can save dollar for dollar more. Now, let's just kind of play this out and assume the future. So after 30 years of doing this, and let's just assume an 8% return, a traditional IRA account balance would be worth $2.265 million. A Roth IRA account balance is $1.767 million. Now, let's look a little bit further. After 30 years, again, 8%, 2.265 versus 1.767. But let's say that now if you need to withdraw, and let's assume it's a 6% withdrawal, well, from a traditional IRA, it's $164,598. From a Roth IRA, it's $128,386. Well, obviously, people would naturally assume that means that the traditional is giving me more money than the Roth. However, let's now then talk about the after-tax amount. So right here, looking at this. So if your tax rate's 22%, then after taxes, you're now going to have $128,386. Roth would have $128,386 tax-free. Now, obviously, this math is not correct. And the reason for that is we know, and it goes back to the slide I mentioned before, the progressive nature of the tax brackets mean that if you're in the 22% tax bracket, your effective tax rate, what you pay, is going to be less than the marginal rate of 22%. But if tax rates are the same, there's absolutely no difference between Roths versus traditional IRAs. All right. Now, if you're fortunate enough to be in what we categorized, or what I called a minute ago, RMD prison, this ultimately means that your taxable income is forcing you up into higher brackets. But if you live long enough, you're either going to have a depleted IRA, or you're going to have RMDs that are greater than your living expenses. For most people, RMDs are not really an issue because we have to compare marginal tax rates versus the average tax rates. And I've got some more examples coming up. But part of the decision that we need to make is ultimately looking at, does conversion make sense? Okay, I got a question real quick. I don't understand marginal versus effective tax rates. So let's go back to this slide here real quick just to explain this. So marginal tax brackets. Marginal tax brackets are determined based upon where your taxable income is at any particular point in time based upon how much income you've made. So for example, let's go back and let's just say now you're single. If you're single and you make $100,000, well, you're going to be in the 24% tax bracket. That's your marginal tax rate. However, your effective tax rate, what you're actually paying the IRS, is going to be less than 24% because the first $9,875 were at 10%. The next roughly, call it $31,000, was at 12%. The next roughly $45,000 of your income was at 22%. And then the remaining $14,500 was at 24%. So your effective tax rate is going up as you go higher in the marginal tax brackets, but the marginal tax rates are the highest effective rate. And it goes back to that conversation I was having about saving. If you're saving, the savings in a 401k account is at the highest marginal. So in that example that I just gave, if you put $14,500 in and you're single, you're actually bringing all of your taxable income from the 24%, and your highest effective bracket is going to be 22. Great question, though. All right. So one of the conversations we want to have is, does it make sense to convert from a traditional IRA or 401k over to a Roth? And so ultimately, this is where everyone's situation is going to be different. Great little flow chart here, but it's obviously we need to look at where your current tax bracket is versus where future tax brackets are going to be. We also need to understand the time horizon. And then lastly, we need to understand is, do you have money to be able to pay the tax bill to do the conversion? Because if you remember, I said converting from a traditional IRA or 401k to a Roth IRA or Roth 401k, you need to pay ordinary income taxes on the conversion. And so we need to do some analysis there. Now, wanted to give you an example of a situation. This is a client who actually retired, and when they were, the year they retired, they had a big tax year, so they're retiring this year. However, we did see as soon as they retired, all of a sudden, they had assets to be able to live off of, and it dramatically dropped their taxable income. So they went from the 37% bracket to down to the 10. And for a nice 5-year window in here, they were in very, very low tax brackets. However, as they started to kick over and need to be living off of their retirement accounts, all of a sudden they jumped up into the 33% bracket again. And then as the RMD percentage was increasing in later years, they then moved to the 35% bracket. I mean, granted, trust me, we're talking about great problems to have here. But when we model this out, we can see that clearly they had a period of time that they were in low effective tax rates. If this is the scenario for you, this makes a lot of sense to look at converting some assets from IRAs over to Roths while we're in low brackets to avoid some of these higher years. And so here's kind of an example of this household's case. In the base case, if they did nothing, again, most of the assets were in retirement accounts. They did not have a whole lot in Roth accounts. But at the end of the day, yeah, they're leaving the kids a lot of money. No big deal. However, if we look at a scenario of conversions, and so this is what we like to call bracket bumping, and we'll look at those low years where they're in low tax bracket years, and then we consider doing some relatively significantly large amounts of conversions from IRAs over to Roth IRAs. So in this example, over a 4-year period of time, we converted about $700,000. Now, yes, that means we need to pay tax on that now incrementally each year. However, look at the difference in terms of how the assets are transitioning to the next generation. They went from having roughly $170,000 of Roth assets to now having $3.2 million of Roth assets. And ultimately, it does lead to them leaving more to the kids. Now, here's a comparison in terms of those required minimum distributions. This particular household, in the base case, they were going to have to pay about $11.8 million of RMDs over their lifetime. But if they did the bracket bumping, all of a sudden they're now paying $10.16 million. So they're actually going to be paying $1.688 million less in RMDs. And you can see that reflected here. So the base case is the blue line. The bracket bumping is the yellow line. And then let's compare the impact of taxes. So instead, in the blue line, we have those low years, which go all the way down. And the yellow line is now comparing if we did some bracket bumping. So yes, we're making the decision to pay some taxes now early on when we would have otherwise been in low brackets, but it's reducing the curve lifetime. And that to me just makes a whole lot of sense. Now I'm using an example that are more high asset value. I understand that. It still applies to people who are in lower asset values for sure. And all the tax brackets are all relative, right? So if we're going to be in the 10% bracket or 12% bracket, and long-term, you're going to be in the 24% for conversions, that still makes a lot of sense, especially if we can be very incremental in nature as we're doing this. And this is just looking at the effective tax rates of doing these conversions. So again, this person would have been in a very, very low effective tax rate environment because we did conversions. We started to increase it. But again, we're reducing the lifetime tax bill here. And that's really the ultimate objective. So when we talk about strategies and when it makes sense or considering doing this, we want to consider converting traditional IRAs, 401ks, 403bs to Roths while retirement accounts are down. But we also want to be mindful of your current bracket versus those future brackets. Now, this chart is phenomenal. Pete built this, but it's showing what is the average tax rate versus what the marginal tax rates are. And if you remember back to that initial slide I said, if average tax rates and marginal tax rates are identical, there is no benefit. But we know that that's not the case because we have what's called a progressive tax structure. So if you're in the, call it 25% marginal tax rates, but your average tax rates are lower, well, then it makes sense to do conversions. And there's a clear delineation of where the breakpoint is associated with doing Roth conversions versus not doing Roth conversions. Now, within the 401k, I get a lot of questions about this from ExxonMobil households. We absolutely should be considering doing some conversions if it's appropriate for you. But before we do it, we need to revisit if net unrealized appreciation makes sense. And the reason for that is because NUA still serves a valuable purpose in terms of long-term tax strategy, but it also potentially could be an impediment for looking at doing Roth conversions more short-term. And so one of the strategies that I think makes sense is let's look at what we're going to need from an NUA perspective, and then look at how much tax paid credit balance you have. So this is somebody who has about 274,000 of pre-87, post-86 tax paid credit balance. By the way, a lot of people get confused on tax paid versus what's listed in the after tax. We do not care about what's in the after tax. We care about what's in the tax paid. But there is a provision within the savings plan that you can actually withdraw tax paid credit balance from the savings plan and move over into a Roth IRA outside of VOIA. But in order to do so, you also have to take the attributed gain on this from the attributed gain off of that 274. So in this example, let's just say they have 274,000 of tax paid, but it's worth $562,000 because that's what it's grown to. So now all of a sudden they can take the 274,000 out, have that go over into a Roth IRA, but then they also need to take out the roughly 280,000 and have that appreciable gain go to a traditional IRA. All right, I have a couple questions in here. What about selling high cost shares in the 401k and now rebuying today at lowest price? I think I actually got the same question price. Or the same question ultimately. So I got this question on a previous webinar we've done. You know, the question ultimately comes down to what is your NUA strategy? Because I do believe that it makes sense to have some of the portfolio allocated for NUA. But if you're in the scenario with a lot of tax paid credit balance, ultimately, it still makes sense to look at doing a combination of NUA and Roth for you. Now, everyone's situation is going to be a little bit different. A lot of employees have high basis shares. Most employees still have some low basis shares. I think those low basis shares ultimately are no-brainers for NUAs, but I don't necessarily feel like it's a blanket recommendation that we should sell the high basis shares to buy new low basis shares. Ultimately, because if we do that, we're effectively increasing the amount that we're targeting for NUA, and that might preclude some of the Roth strategies as well. So to answer the question is, I think everyone's situation is going to be a little bit different. I'm happy to do an NUA analysis for you to give you our recommendation. But I think that ultimately we need to look at everyone's situation a little separately. But if you happen to have if you do not happen to have any low basis stock at all, but you've got a significant amount of this tax paid credit balance, it might make sense to go ahead, take out the tax paid credit balance, put it in a Roth IRA, also take out the attributable gain off of that, and get that money now growing in the Roth IRA tax-free forever. Because remember, as long as this tax paid balance is in the savings plan and listed as tax paid balance, that growth is happening on a before tax basis. We need to get it over into a Roth so that that growth is now happening tax-free. And so ultimately that's the objective of what we're talking about here. But for both of those questions that came in, I'd say we got to run a plan and look at your situation as to what makes the most sense. But I do really like this withdrawal strategy. Now, I will also tell you, I highly recommend having an advisor on the line who knows what they're doing, because VOIA is not necessarily the best at knowing how to calculate these. So just something to be mindful of as if we're doing it. Now, I also know that there's been a tremendous amount of comments on the internal messaging board at ExxonMobil about doing conversions within the plan. So remember, a moment ago, I'm talking about withdrawing money, taking it out of the savings plan. You also have the ability to do conversions within the savings plan. However, we still need to be mindful of what the NUA strategy might be. And there could be some absolute unexpected consequences of doing conversions within the plan. So for employees who are younger than 59 and a half, you have the ability to convert their after-tax and general accounts over to the Roth conversion account. However, your before-tax account cannot be converted. For employees that are 59 and a half and older, you can convert all of the accounts, the after-tax, the general, and the pre-tax account over the Roth conversion account. Now, for all intents and purposes, the basis of your stock in the savings plan ultimately doesn't matter with regards to tax purposes and determining conversion amounts. So for example, if you're talking about selecting the high cost basis shares to convert, the IRS ultimately just looks at the gross amount, and they're gonna assign what the after-tax contributions are associated with it, but the basis is essentially irrelevant. Now, one thing that I'll caution people, if they're thinking about converting some of the high basis shares, trying to preserve the low basis shares, and then converting those over the Roth conversion account, Voya makes you sell the stock in order to be able to do the conversion, and then they convert cash over. So you could have effectively have a 5 to 7 day period of time where it's been sold, it's sitting in cash, and as we've seen in this market environment, a lot can happen in 5 to 7 days. So be mindful of that if you're trying to do this. But to give you an example of what I'm talking about in terms of conversions within the plan, let's just say that the entire after-tax account, let's say it's about 60% is after-tax contributions and about 40% of its gain. So if someone were to decide to convert 100% of the after-tax account over to the Roth, well, they're going to have 40% of that gain is treated as taxable income. If they're going to convert, let's just say half of it, well, 40% of the 50% is taxable income. If they're going to convert 10%, then 40% of the 10% is taxable income. That's why I honestly believe that if we're looking at converting taxable tax paid credit balance or after-tax assets over, we really should come back and consider this withdrawal strategy and have the tax paid balance go to a Roth, have the gain go to a traditional IRA. That way we're not creating an unintended tax consequence here. All right, a lot to be said so far. Now, I did want to talk a little bit about what are called backdoor Roth contributions. So I go back, and I know we've been talking about converting IRA accounts over while you're employed. I've been talking, or excuse me, IRA accounts over while you're retired. I've also been talking about converting amounts within the 401k plan. But there's also one other strategy that I think makes a ton of sense. And this is if you do not have IRA accounts outside of your retirement accounts, you actually have the ability to still get money into a Roth account. We just need to utilize an additional strategy. Now, if you remember, I said that the ability to do Roth conversions previously, prior to 2010, was capped on 100 grand, and then that income threshold went away. So now, if you ultimately are in a very high bracket, you might not have any IRA accounts, or your spouse doesn't have any IRA accounts, you're able to still get money into a Roth by doing this strategy called the backdoor Roth. And so what we're doing is we're actually going to do the contribution into a traditional IRA. And again, because you're in a high bracket, you're not able to take a deduction. So it's an after-tax contribution that you've put in there. And then we can immediately convert it over to a Roth. And because it was an after-tax contribution that we put in, we have the ability to immediately convert it and have absolutely no tax impact on doing it. Now, the most critical thing to note here is you cannot have an IRA account balance in order for that conversion to be tax-free. Otherwise, it's considered prorated conversion, and a part of it would be taxable. And if you're in a high bracket, that doesn't ultimately make sense. All right, didn't get a whole lot of questions on this, but I do think that, especially if you've got a couple years left of working, this is a phenomenal strategy to use. Is the backdoor conversion possible on an old IRA, not new contributions? So if you have an existing IRA, to get money converted to a Roth tax-free, that doesn't make any sense. Because again, it goes back to that comment that I made a moment ago, that if you convert IRA balances, it's treated as ordinary income. And if you put an after-tax contribution into an IRA and you still have some pre-tax in there, anything you convert is going to be prorated in terms of the taxability of that conversion. All right, another question. So if I have an existing traditional IRA account, you cannot do the conversion of new money. Well, no, you could still do the conversion. It just doesn't make sense if you're in a high bracket, because ultimately you're creating more ordinary income in a high bracket. Whereas I would make the argument for somebody who's going to retire, they're going to be in a lower bracket in the future. And that makes sense. If you're going to be in a lower bracket in the future, let's just wait to do the conversion until we're in the low bracket. and then create the ordinary income on the conversion when we're in those lower bracket years. Okay. So I'm going to kind of wrap things up a little bit here. Some strategies to consider now. First and foremost, you got to have a plan, got to have a financial plan. We need to look more holistically. We need to understand not only what your budget is, what your future expenditures are. We also need to understand what your long-term risk profile is. It's important to have your goals aligned, because if your risk profile and your time horizon have not changed, your portfolio structure should not change in terms of reacting to a market scenario. Using emotion from an investment perspective is not a long-term investment strategy. And we're doing our absolute best to shelter clients in this environment, because again, retirement assets should be structured for long-term. Even if you're getting close to retirement, we need to look at things holistically. Now, one thing that I think makes a lot of sense is increased savings in retirement accounts now that the markets are down. And especially if you have the ability to do some extra on the after-tax side, do it now while things are down. I would also look at doing some tax loss harvesting if you have after-tax assets that are now down. Maybe we look at selling assets while they're down and then immediately buying something else that we think is going to rebound faster. We're actually seeing a lot of that for those that have restricted stock, that the basis is higher. We've got some losses there. Let's go ahead and look at selling ExxonMobil to harvest the losses and then immediately buy something else. Consider converting the tax paid to a Roth IRA, as I was talking about a moment ago. Also, interest rates are still very low. Consider refinancing existing debt. And I would say that ultimately, if you have a financial advisor and if you have not heard from them in the last 4 weeks, are they really the best advisor for you? I would say that look at having a strategy. So one of the calls to action for any of the planning work that we're doing, or any of these educational events that we're doing, is to sit down and run your numbers. If you haven't done a plan, I would argue that now's as good a time as ever. If a plan works while the accounts are down, then it's really going to work once we do ultimately see a recovery on the market here. We do that completely, no cost, no obligation. It's one of the services that we provide. And ultimately, if you have any other questions, please feel free. Let us know. We're more than delighted to be a resource for you, because I think that there's a lot of benefit in long-term planning work. There's a lot of benefit in continuing to be more educated. I got another question that came in, sorry. Also, I heard you say consider converting some tax deferred to Roth too. So pay tax now versus RMD time. Yes, absolutely. So while assets down. So again, kind of going back to that example I did a few moments ago here, this example here. If we know part of the long-term strategy is to do Roth conversions, and we're going to ultimately be doing them each year while we're in low brackets, especially early on in retirement before your RMDs start up, let's do them now while the accounts are down, because we do genuinely believe 12 months from now, things are going to be significantly higher than where they are. Whatever rally or rebound we see coming off the market, I'd rather have it be on the Roth side than in the pre-tax side, and then we wait until the end of the year to do the conversions then. So absolutely, if Roth conversions is part of your strategy and it's something that you've been doing, absolutely consider doing it now sooner than waiting until the end of the year to do it, because ultimately I want to get that growth in a tax-free environment. All right. I did just want to leave with our contact information. We are delighted to do a plan at any point in time. Please feel free to reach out to any one of us. We're always going to be a resource for you.